Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good morning. And if you're trying to make sense of the economic and, frankly, geopolitical whirlwind of the last 24 hours, well, there's a lot.
There really is.
You're in the right place, though. We're digging into reports from CNBC, Bloomberg, Yahoo Finance, and Reuters today, trying to give you that essential context before the weekend.
Yeah, and today it's less about just listing headlines, isn't it? It feels like we need to untangle this flood of news.
Absolutely.
We've got major trade policy shifts, big market swings globally, that TikTok deal finally getting sorted,
Right.
and some pretty intense political fights brewing in Washington. It honestly feels like weeks of news packed into Thursday night and Friday morning.
It does. The themes, they really intertwine. You've got these new tariffs trying to reshape supply chains almost overnight. And then domestically, this growing uncertainty. Think Fed independence, a potential government shutdown. It's all connected. Understanding those links is, well, critical today.
Okay, let's jump right in then. The huge news, the thing that seemed to kick a lot of this off, was the announcement of new U.S. duties late yesterday.
Via Truth Social, yeah.
And the sheer scale and breadth of these tariffs, starting October 1st, it seemed to catch people off guard.
Definitely. And the headline grabber, the one every financial outlet focused on, was that massive 100% tariff.
On pharmaceuticals.
On any branded or patented pharmaceutical product.
Yeah.
I mean, 100%. That's just an extraordinary figure. It screams maximum leverage.
100% duty. My first thought is, okay, supply chains just freeze, prices for consumers go through the roof. How did the markets not just completely melt down on that news?
Well, because, and this is the crucial part Bloomberg really highlighted, the tariff is kind of designed to be avoided.
Avoided? How?
There's a massive exemption baked in. Companies get immediate relief from that 100% hit if they are actively building drug manufacturing plants in the U.S.
Actively building, like shovels in the ground.
Exactly. Even if they've only just broken ground. That's the key detail.
Okay. So this isn't really a tax, is it? It's like a giant hammer saying, build here now or else.
Precisely. It's a massive, maybe heavy-handed incentive for immediate domestic investment aimed squarely at companies that can afford it.
Right.
And reading between the lines in the reports, it looks like they're using trade laws, probably Section 232, that give the president a lot of power to act fast on national security grounds.
Which explains how they could hit so many different sectors all at once.
Yeah, it wasn't just medicine, was it?
Not at all. We saw big industrial stuff, everyday home goods.
Right. A 25% tariff on imported heavy piece trucks. The sources explicitly say this is to protect U.S. makers like Peterbilt, Kenworth.
Okay.
Then, total different area, home goods. 50% on kitchen cabinets and bathroom vanities.
50%.
And 30% on upholstered furniture. The reason given.
Yeah.
Just flooding of imports, in all caps, apparently.
So big trucks, medicines, kitchen cabinets. It's a really broad sweep, a sudden acceleration in trade policy hitting everyone from huge corporations down to, people redoing their bathrooms.
And the world is noticing. Fast. Reuters is reporting Malaysia has already formally asked the U.S. for zero tariffs on their furniture, auto, and aerospace exports.
Trying to get ahead of it?
Desperately. They want a deal before some October summit, clearly scrambling to avoid getting caught in the crossfire like others before them.
So the global ripples are spreading, but the market reaction itself, it's been fascinatingly uneven, hasn't it? Let's look at Asia first, where the news hit overnight.
Yeah, Asia's reaction was, brutal, just immediate shock. South Korea's Kospi index led the way down, dropping 2.45%. And that was heavily driven by pharma stocks. Japan's Topix Pharma Index fell nearly 1.5%. Specific names got hammered. Sumitomo Pharma down over 5%. Daiichi Sankyo over 2%. SK Biopharma down almost 4%. Even Alibaba Health, listed in Hong Kong, fell nearly 3%. The initial take was just disaster.
Okay, pure panic in Asia. But then you look at Europe, reading the CNBC reports this morning. The main pan-European index, the Stoxx 600, was actually slightly up, like 0.2% higher overall. It looked like Europe just shrugged it off.
That's the surface reading, yeah. But it's a bit misleading, I think.
How so? Because surely some sectors got hit.
Exactly. If you scratch beneath that headline number, The European healthcare sector definitely had a rocky time.
Ah, okay.
You saw names like Denmark Zealand Pharma down 2.5%. Novo Nordisk saw losses. Finland's Orion, too,
Yeah.
initially down over 2%.
So the broader index being up was masking pain in the specific area targeted by the tariff threat.
Absolutely. It suggests that while other factors maybe lifted the overall market, the companies directly in the crosshairs were reacting.
So the market did its homework pretty fast. Realized, okay, big, scary 100% number, but that exemption clause, it makes it avoidable, at least for the big players who can afford to build in the U.S.
That's exactly the analysis coming out from firms like Bank J. Safra Saracen, which Bloomberg cited. Their strategists were basically saying, hold on, don't rush to dump your pharma stocks.
Right.
They argued that the administration probably doesn't want massive consumer price hikes, which this tariff would cause if fully implemented. That makes the policy itself politically risky.
So the market's reading it more as a powerful negotiating tactic, a way to force investment rather than an inevitable cost increase.
Seems to be the case, yeah. A very big stick, but one with a potential escape route.
Okay, so trade turbulence is one big story. But there were huge domestic policy moves overnight, too. Let's
Yeah.
talk TikTok. That saga seems to be over.
Well, almost. We have an approved deal, assuming China signs off. An executive order was signed, greenlighting a deal valued around $14 billion.
$14 billion, that's huge. A relief for investors, users, everyone involved, probably.
Definitely. And the structure seems designed to address those national security worries. A new joint venture company takes over the U.S. side.
Right, and ByteDance, the original Chinese parent, keeps less than 20% stake.
Less than 20%, yeah. Hey, look who's involved in the new structure.
Ha!
Oracle, Silver Lake, Abu Dhabi's MGX. These are serious players.
So control shifts away from China. But you mentioned a caveat.
The big one, China still needs to approve the terms of this specific sales structure. And, well, that's never a guarantee.
Okay, something to watch. So, some certainty in tech with TikTok, but elsewhere in Washington, a lot less certainty, specifically around the Federal Reserve.
Yeah, this is potentially a very big deal. It centers on Fed Governor Lisa Cook. The president is attempting to remove her from office over alleged mortgage fraud from before she joined the Fed, allegations she strongly denies.
Okay.
Her lawyers have taken this to the Supreme Court, and their argument is fundamental. Allowing her firing would, quote, eviscerate the independence of the Federal Reserve Board.
Okay, let's unpack that for listeners. Why is Fed independence such a big deal? Why does this one case matter so much?
Because the whole point of the Fed, its structure, is to insulate it from short-term political pressure. You want monetary policy focused on long-term goals, like stable prices, not, boosting the economy right before an election.
Right.
And the sources confirm the president has complained the Fed wasn't cutting interest rates when he wanted them to. So if a president can just fire a governor who doesn't toe the political line, the Fed stops being independent. It becomes just another tool of the administration. That's the fear.
So Cook's lawyers are saying this isn't just about her, it's about the institution itself, preventing political interference in monetary policy.
Exactly. They're calling the charges flimsy, unproven, and, importantly, conveniently timed after the president criticized the Fed's decisions.
And it's not just her lawyers saying this is serious.
No, not at all. Almost every living former Fed chair, several former Treasury secretaries, they've all filed briefs with the court, basically backing her argument and warning against undermining the Fed's independence. That tells you how serious the establishment views this.
Wow. Okay, so a fight over the Fed's soul. And as if that wasn't enough drama, October 1st is looming, and so is a potential government shutdown.
Yep. Yahoo Finance is reporting the odds are definitely ticking up. And interestingly, sources are saying both political parties might see some kind of political upside in a shutdown this time.
That's concerning. Usually someone wants to avoid it.
Well, here's the detail that really stood out, connecting back to this theme of aggressive policy moves. It's a memo mentioned in the source reports. The White House has apparently asked federal agencies to plan for mass firings as part of a shutdown.
Mass firings, not furloughs.
Firings, specifically targeting areas not consistent with the president's priorities.
That's a whole different level. That's not just pausing government. That sounds like using a shutdown to fundamentally reshape parts of the federal workforce.
Yeah.
Weaponizing it almost.
It really changes the calculation, doesn't it?
Yeah.
It signals this isn't just a budget squabble. It suggests a willingness to pursue permanent structural changes through the shutdown process. That forces markets to price in a different kind of risk.
Definitely. Okay, let's shift gears to specific sectors. Energy saw some big moves this week. Oil prices are up.
Yeah, significantly. According to Reuters, oil's heading for its biggest weekly gain in over 3 months. Brent crude broke above $69 a barrel. That's a jump of about 4.4% for the week.
And this isn't just regular market noise. What's driving it?
It looks like serious geopolitical factors. Two main things stand out. First, the U.S. seems to be putting more pressure on countries still buying Russian energy, specifically mentioning Turkey and Hungary. That potentially tightened global supply. Second, those Ukrainian drone strikes on Russian energy infrastructure, they're continuing. And that ingests real volatility and supply disruption risk into the market. So sanctions enforcement plus physical risk.
Got it. And speaking of energy companies, BP has had quite a run.
An incredible turnaround, really. Their shares are up over 32% just since early April. Remember all that takeover talk earlier in the year? Shell, Exxon?
Yeah, they seemed vulnerable.
That talk has pretty much died down now. That 32% jump took them out of the immediate spotlight.
Turned it around.
It's like a combination of things. A real strategic reset, selling off non-core stuff, focusing on higher margin projects like deep water drilling. Plus, a leadership change, new chairman Albert Manifold, officially starts October 1st. And then, finding more oil helps too, like that discovery in Brazil.
Sounds good, but there's always a but, isn't there? What's the risk for BP?
Debt. Always a debt with BP, it seems. Energy analysts quoted in the reports point to their high net debt, $26 billion in Q2? They call BP the most exposed in the peer group if oil prices were to fall sharply again, say back towards $60 a barrel. Suddenly, that debt looks very heavy, and maybe the takeover chatter comes back.
Something to keep an eye on. Okay, finally, let's hit the tech sector. It's been volatile. U.S. markets were down again yesterday.
Third straight day of pullbacks, yeah.
Yeah.
S&P 500, NASDAQ Composite, both down about 0.5%.
Any particular laggards?
Some familiar names taking profits. Oracle was down 5%, Tesla slipped 4%. Pretty standard stuff after big runs.
But there was one tech stock going absolutely nuts in the other direction. Intel.
Intel, just stunning. Up nearly 9% yesterday alone. And for the month of September, up around 40%.
40% in a month? What on earth is going on there?
This is a huge story unfolding. The surge yesterday came on reports that Apple might invest. This follows NVIDIA making a significant investment just last week.
Apple and NVIDIA investing in Intel. That sounds counterintuitive. Don't they usually compete or build their own stuff?
Exactly. That's what makes it so significant. It's not just about Intel's own chips getting better. It suggests two of the biggest tech players, who normally love custom silicon, are now betting on Intel's manufacturing capabilities, their foundry business.
So what does that signal?
It signals, I think, a massive vote of confidence in Intel's shift to making chips for others. It suggests that for the sheer amount of computing power needed for AI, these giants realize they need external partners. And they seem to be coalescing around Intel as a key US-based option.
Wow. So it's about manufacturing capacity for the AI boom.
That seems to be the core narrative driving this incredible run. It's why the stock's moving like it hasn't since, maybe the late 80s or early 90s.
We also saw IBM pop a bit on quantum computing news.
Yeah, up over 5% after a successful test. Shows deep tech can still move the needle. But then you see the flip side, that nuclear startup, Oklo, down about 15% in 2 days. Volatility's still out there.
Institutional certainty gets rewarded, speculative tech gets punished. Seems like a theme.
Pretty much.
Okay, so let's try to wrap our heads around all this. Pulling from CNBC, Bloomberg, Yahoo Finance, Reuters, we had those sweeping 100% pharma tariffs, but with that crucial build here exemption.
Right.
We had the sharp Asian market sell-off, but a more stable, maybe deceptively stable, European reaction. The TikTok deal finally approved at $14 billion, pending China's okay.
Yep.
That fundamental battle over Fed independence landing at the Supreme Court.
It's a big one.
And the rising threat of a government shutdown, now with this chilling talk of potential mass firings, just an incredible amount of news, gives you a lot to chew on over the weekend.
It really does. And maybe as you're processing all this, this huge volume of policy action, here's something to think about looking ahead. Given how broad these new tariffs are, hitting everything from trucks and medicine down to bathroom vanities, and how they're explicitly designed to force domestic manufacturing, what does this rapid expansion really signal about how trade policy, maybe Section 232 specifically, might be used to reshape global supply chains going forward? And maybe more importantly, will the price increases that seem inevitable for U.S. consumers eventually undermine the political support for these long-term manufacturing goals? That feels like the real tension point to watch.
A very provocative question indeed. We'll see you all Monday morning with new headlines from major financial magazines.